Okay, so welcome back, everyone. It's been a while, hasn't it? Anyway, so I have put together a small presentation that I'd like to share with you guys today. But before we do that, just a small reminder, I do not teach ICT concepts, okay? So when I refer to them, it is only in a capacity that reflects my understanding. So my ideas, my analysis, and the understanding that I'll put forth to you is entirely subjective in the way that it represents my opinions. Okay. If you're going to study ICT concepts, or you haven't started yet, I suggest doing so using the free content available, obviously on his YouTube or through his Twitter. And everything that I refer to here can be found on those platforms. So, with that out the way, I will get into why I've decided to make this presentation. Now, this video is a kind of response to a recent tweet in which ICT asks trading mentors to create a video in which they discuss what type of setups they would trade if they could only trade one setup for the rest of their lives. The way I have developed as a student of ICT, that is, the type of concepts I have resonated with, have meant that I don't focus on any one condition type insofar as it reflects a high probability setup. So what I mean by this? Well, I've grown to accommodate multiple profiles. These profiles are based on ICT's work in intraday market profiles with particular observance to London trading session. I have studied how these profiles exist as templates that, when employed as an anticipatory skill, manifest as 4 recordable forms. We are familiar with them as being categorized by the following. So the first one is the bullish profile or buy profile. And this can manifest as a delayed protraction or standard protraction in reference to the trend which precedes midnight, in which we anticipate as ending at or just after 3 a.m. And the second is being the bearish profile or sell profile, which we anticipate as forming either from a standard protraction or delayed protraction state, relative again to the midnight trend, ending at or just after 3 a.m. So in the following panels, I will be expanding on these intraday profiles by introducing the 4 types of intraday profiles as they relate to the London session, focusing on 2 to 5 a.m. I will also suggest a checklist relevant to each profile. They'll be distinguished by an anticipatory and an entry stage. So anticipatory stage will involve a set of skills that we should develop that allow us to identify the highest probability trade conditions, and an entry stage in which I will suggest a list of identifiable characteristics which can enhance your accuracy. So this list can be used to identify preferable trading conditions, like I just mentioned. Also, I'll suggest ways in which to use certain PD arrays that will enhance our accuracy in the identification of these profiles. The first profile up for consideration is the bullish normal or standard protraction profile. As mentioned before, I'll offer a list of key conditions that can be anticipated, followed by a list of potential entry criteria. Now, not all of these criteria need to be observed during any one profile formation, but we should at least be able to identify three or more of these conditions. So the anticipatory stage or anticipatory conditions. This profile should display a narrow Asian range, one that does not exceed the upper limit of 20 pips. Ideally, at midnight, we should note some measure of decline, so that by 1:30 a.m. a lower low is formed than that which was created in Asia session, or in New York PM session trading, assuming that the central bank dealers range and Asian range were significantly narrow. From here, we should anticipate the low of the day to form between 2 and 3 a.m. Anticipate a total soup reversal that displays signatures related to offset accumulation. SMT divergence that forms at the lows can validate this prediction. Another anticipatory condition involves the use of fair value gaps. Any fair value gap formed during Asia or in the decline after midnight should be extended until 5 a.m. Often these prices are referred back to in London Killzone. We will look at some examples of this in the next few slides. This profile is all about anticipating kilos intraday. We can do this with a high degree of prognostication by blending discount PD arrays with the standard deviation of Asia session and the central bank leaders range. So moving on to entry conditions. In this profile, we can refer to some of the following conditions when considering higher probability trading opportunities. So moving on to the entry conditions. Here we can refer to some of the following conditions when considering high probability trade opportunities. So the first thing we like to see is some form of SMT divergence at the total soup, which will validate liquidity grab below a short-term low. And this can happen. Generally happens between 2 and 3 a.m. Obviously, if we're trading into discount PD array, the fair value gap, order block, previous day low, previous session low, this further validates a reversal. If from this reversal we note a particularly energetic movement, we can say that smart money is currently active. We like to see displacement through opposing PD arrays. I namely like to look at fair value gaps. We like to be able to identify relative equal highs. So these will be early targets for any trades taken at the turtle soup reversal. If trades are not taken early, you can have a look at trading a return to fair value between 3 and 4 a.m. Oftentimes we get an opportunity to enter into continuation trade when price returns to any standard fair value gaps or inverted fair value gaps. And remember, they would like to see candle bodies close inside these fair value gaps, right? And we let the wicks do the damage. All this should be considered in reference to the midnight price. So any trades that form above the midnight opening price are considered preferable. With these conditions in mind then, let's go ahead and look at the first example of the bullish normal protraction. I'm going to lay out some of the relevant conditions that validate this profile. Firstly, we should anticipate that the market is reaching for a higher time frame daily or weekly drawn liquidity. Secondly, this model reflects a buy program, specifically a price engine model called offset accumulation. The characteristics of this model require some measure of sell-side liquidity to be engaged under an old low. Therefore, ICT tells us that we should anticipate sell stops to be triggered, inducing counterparty sellers to pay long entries with. In line with this, price will seek a higher short-term premium array to offset positions. This model unfolds quickly, so it is essential that we are able to forecast kilos intraday. We note previous day lows, intra-week lows, previous session lows, as well as previous week lows. We use standard deviations of the central bank dealers range and Asian range to project and enforce areas of high confluence. The protraction stage in this profile reflects turtle soup conditions, the validity of which is confirmed by institutional SMT divergence. If we confirm institutional SMT divergence or institutional sponsorship, we can move on to a number of qualifying factors. In this example, price is seen to trade above a swing high. Displacement confirms algorithmic price delivery. We can use inverted fair value gaps to measure changes in what pricing program is likely underway. So, are algorithms changing predominantly to buy programs is what we want to see or determine. As fair value gaps become inverted and are reclaimed, we note a shift in market structure. We can use a return to fair value continuation trade as an entry model between 3 and 4 a.m. To reiterate on some of the key points in this example, we refer firstly to the bearish trend after midnight. This constitutes the bare minimum criteria for a bullish standard protraction profile. So once we confirm a lower low before 1:30 a.m. in reference to Asian session or the lows created in New York's PM trading, we move on to another anticipatory stage, and that is the reversal. We can try and forecast key lows intraday by blending together discount PD arrays with the standard deviation extensions of Asia session and the central bank dealers range. We will make note the time in which price engages these levels. And if we are entering into London Killzone, and it's also supported by high impact news, we can begin to hunt SMT divergence between 2 and 3 a.m. Due to the cyclical nature of price action, the start of the hourly candle can tend to sweep the lows or highs, in this case, the lows of the previous hourly candle, especially if the aforementioned candle is trading at the lows when it closes. Therefore, note a bleed over into 3 a.m. for likely reversal time windows. If some of these conditions are satisfied, I move on to other qualifying factors. In this example, the footprints of algorithmic price action are seen as standard fair value gaps are inverted and retested as support. Swing highs are traded through, leaving displacement. These signatures allow us to engage the market with the highest degree of probability. Let's move on then to the next example. So this will be our second example of the bullish standard protraction profile. So let's talk about some of the key components in this example. So again, we have the minimum basic criteria in which price is seen to trend bearish after midnight. And between 2 and 3 a.m. is when we see the reversal. And between 3 and 4 a.m. we have an opportunity to enter into a continuation trade. In this example, initially at midnight there was a small rally as price returned to this small inefficiency right before expanding lower. Then at this area here, price trades through a swing high. This is a shift in market structure, and again as it moves through it leaves an imbalance. So this imbalance will be can be targeted between 3 and 4 a.m. and this will be the criteria for a silver bullet entry. And you can see an opportunity to enter again on a return to fair value. This entry is particularly valid because it's a continuation entry above the midnight open. So again, really good example with standard protraction profile in which price is seen to trade lower initially after midnight before reversing between 2 and 3 a.m. before giving us a continuation trade opportunity, return to fair value setup between 3 and 4 a.m. again before expanding higher. So let's move on then to the next example. Example 3, bullish standard protraction. So I have here noted on the side that kilos can be anticipated by referring to discount arrays, standard deviations of central bank dealers range, Asian range, SMT divergence, and intermarket confluences. So essentially, again, what we're getting at here is that this profile is highly dependent on our ability to forecast intraday lows. The way we do this is by finding the highest level of confluences. In this instance, we have a return to fair value, 1 hour standard fair value gap, and inside the fair value gap we post SMT divergence before price expands higher. So what makes this initial expansion a legitimate reversal? Well, there's a number of criteria. The first of them generally requires some form of SMT divergence to be posted between the euro and dollar. This should happen inside of a discount array, inverted fair value gap, standard fair value gap, or order block. As pricing expands, we can use inverted fair value gaps to measure shifts in market structure or shifts in sentiment as price moves from a buy model to a sell model. So you'll see in this situation, as price expands through the fair value gap here, it retests it multiple times. Support as the wicks do the damage and the bodies close inside of the value area of the inverted fair value gap. Again, note the time between 3 and 4 a.m. so that displacement leaves an opportunity to trade a silver bullet continuation trade. Right, let's move on to our next profile, which is going to be the delayed protraction bullish profile. Before we can employ our anticipatory skills, we have to have access to a higher time frame bias. We look for daily, weekly, or monthly drawn liquidities that will guide our analysis so that when we project our conditions on price action, it can be done with an assumption that price is more likely to move towards premium targets above market. Given this context, let's discuss the anticipatory conditions we expect to see in this profile. Firstly, the market will establish a bullish trend after midnight. Higher highs should be seen than those created in Asia or New York's PM session. If the market posts a shallow Asia session that leads into a consolidated midnight trend, then we should consider external range liquidity targets during the protraction. We will look at example of this later as well. Ideally in this profile, a protraction precedes a bullish midnight trend so that the retracement targets internal range liquidity represented by the normal discount PDF matrix. We should anticipate this protraction at or just after 2 a.m. It accumulates at or just after 3 a.m. The next anticipatory stage has got to do with the details of the protraction. So firstly, we should anticipate a retracement back into any range formed before 2 a.m. Like I said before, external range liquidity targets can be considered if the midnight trend is particularly shallow. Something, again, we'll have a look at in the upcoming slides. So in the notes here, I have suggested identifying swing lows and inefficiencies relative to the midnight dealing range. Swing lows represent liquidity in the market and fair value gaps represent inefficiencies. ICT tells us that the algorithm refers back to these levels and will use the liquidity or balance a price range as a reason to reverse. This type of repricing in this context is referred to as reaccumulation. We can say that smart money is reaccumulating buys in the euro. The ability to anticipate reaccumulation is one of the main conditions that allow us to trade this profile successfully. Knowing the context of when to expect reaccumulation as well, but we still need to know how to identify it. Identifying reaccumulation is part of the entry conditions I want to see reflected in price action. Without going too much in depth in respect to the analysis of institutional market structure as it is reflected in SMT studies, I will note here that the perfect reaccumulation happens at the candle's bodies. So when we see wicks that trade lower than previous wicks, but the bodies of that candle close higher than the previous lowest candle's close, we denote underlying strength in the euro. At the same time, in the dollar, we want to see candles close above the previous highest close. The dollar in this case is said to be distributing longs above an old high. This insight is suggestive of a strong sell program in the dollar, in which longs are being distributed at premium prices. Buy stops are being triggered, inducing counterparty buyers to pay short entries with. In essence, we are able to see evidence of two opposing price engine models: a sell model in the dollar and a buy model in the euro, displayed when institutional market structure is asymmetrical when comparing the candles. Don't worry too much if that description didn't quite resonate with you. I will go through an example on the next slide, and I'll visually show you an example of reaccumulation as it happened. Moving on, let's quickly discuss some of the other entry conditions. There's essentially alliterations on reaccumulation model, but we'll just go through them for completeness sake. Short-term lows or short-term liquidity, we like to see that being engaged below a swing low. So essentially, think the 2022 model. It's helpful if we have relative equal highs above market at the time. A strong supporting confluence is when price trades back into an inverted fair value gap and reclaims it as support. So if price is retracing and we return back into an inverted fair value gap, we like to see the candle bodies close inside its value area. And if, for instance, there is a fair value gap above market at the time that perhaps initially rejected price, like in the example on the right hand side here, when price or when the market reprices back to that level, we like to see a displaced candle that opens below that fair value gap and then is seen to displace through it, closing outside of its value area. This is a strong indication that there is institutional sponsorship on the side of buying. Right, so in line with this, we might have an opportunity to enter on a return to fair value or a silver bullet setup between 3 and 4 a.m. And a reminder that long entries that form above the midnight open are optimal. So we'll move on then to the examples. Moving on then to the first example of the bullish delayed protraction. I have some key features noted at the bottom here. Obviously the first one addresses the midnight trend, which in this profile is bullish, and this will extend to about 2 a.m. in the morning. Here we see a rejection as the market reprices a 1 hour fair value gap. Generally at this time we anticipate a protraction. In this case, we aim to key off discount PD arrays relative to the trend just established at midnight. Liquidity is engaged below a short-term low in adherence to hourly cycle theory, which allows previous hourly candles lows to be engaged should it close trading near those lows, right? And you'll also note lower lows are formed at the wicks, while higher lows are seen to form at the candle's close. We will compare this to the dollar in the next slide, and we'll see that we'll actually post the SMT divergence here. So lastly, in this protraction, we note how those candles close inside the value area of an inverted fair value gap as it was created in Asia's trading. Lastly, we note a displacement through opposing PD arrays, in this case a swing high. And we can use a return to fair value continuation trade, silver bullet setup, as price returns to this imbalance. So this is a 5-minute and 1-minute chart of the previous example. You'll see more closely evidence of reaccumulation. Higher lows at the close of the candles, we have low lows at the wicks. On the dollar, you'll see distribution above its previous high. So again here on the 5-minute chart, we're able to see displacement through an opposing PD array, swing high, fair value gap. This gives us an opportunity to enter into a trade at this location as that fair value gap is inverted and reclaimed as support. You'll see how the candles close, in this case outside the value area, just at the top of it. So these type of signatures are indicative of institutional sponsorship, and we can infer with a high degree of certainty that the euro would currently be bullish. Moving on then to our next example. So again, we have a midnight trend advancing. Price is able to make higher highs than those posted in Asia or New York PM's trading. So we have a bullish midnight trend. And here on 2 AM, we experience a delayed protraction. This extends until 3 AM. It is liquidity seeking in nature. So we aim for any imbalances or liquidity as it exists relative to the previous aforementioned trend or dealing range. In this case, again, we have a silver bullet setup which forms between 3 and 4 as price returns to its inefficiency, and we see candles close inside its value area. Moving on then, so this is our final example for the bullish delayed protraction. This example we see a situation in which the midnight trend is particularly shallow. In this case, the protraction period can be seen to engage external range liquidity as it exists below the midnight trend or below the lowest low in Asia. We have a displacement here. Displacement reflects institutional buying as a key consideration to high probability reversals. We have a swing high which is traded through here. We have a return to fair value. Silver bullet setup between 3 and 4 AM. Prices seem to expand higher. Moving on then to our next profile. The next profile we're going to discuss is the bearish stand protraction. So just like in the previous two profiles, we should have established a higher time frame, daily, weekly or monthly draw on liquidity below market. Okay, so starting the anticipatory conditions, this profile is highly dependent on the previous day's central bank dealers range and Asian range. So these should be relatively tight, and they shouldn't exceed more than 25 to say 30 pips. Even 20 pips would be considered quite a large range, especially in Asia. Another aspect of our anticipatory skills in relation to this profile is the fact that we can or should use deviations of the central bank dealers range and Asian range as targets used to project the likely range the protraction can extend to. In this profile, the midnight trend should be seen to make higher highs than those in Asia. The trend should extend until 2 AM. Now between 2 and 3 AM is when we expect the high of the day to form. So when do we expect the high of the day to form? At this time, when price is moving above an old high. So this can be a previous day high, but we can also use the highs of the last 3 days. Also, a previous session's high can be used, and we can also use previous week highs. So we anticipate a total soup sell above those aforementioned highs, and we anticipate some measure of SMT divergence reflecting institutional selling. In this profile, buy stops will be triggered, inducing counterparty buyers to bear short entries with. As a consequence, price will seek lower short-term discount arrays to offset positions. Should we note some measure of SMT divergence reflected in offset distribution model? If we note the violation of a swing low, we anticipate a market structure shift. Moving on to the entry conditions that I like to see. The main condition that I like to see when trading this profile is the presence of SMT divergence, as price is seen to trade above an old high. I want to see the euro post an offset accumulation model. I want to see candle bodies close higher than those of the previous highest candles close. And I want to compare that against the dollar. In the dollar, I want to see some measure of accumulation. I want to see candles bodies closing higher than the previous lowest close. At this point, should the market reprice below a swing low, I would consider this a valid shift in market structure. Moving on then to the next entry condition, I want to see here some measure of a return to fair value. So we could be rebalancing a standard fair value gap or retesting as a resistance an inverted fair value gap, observing candles that close inside their value area. So I always try and use a return to fair value where possible, because the way price trades relative to them allows us a means by which to measure shifts in sentiment that can otherwise reflect a change in the price engine model. So ICT notes that any inverted fair value gap or standard fair value gap can be used as a point of reference, a means to measure shift in sentiment as price shifts from a buy to sell program or from a sell to buy program. In line with this logic, some confluences I like to see then are inverted fair value gaps acting as resistance to higher prices when retested, and this is observable when candles fail to close above the value area. And again, we always prioritize setups that form below midnight open. Let's go ahead and have a look at the first example of the bearish standard protraction. So in this example, you will note a midnight trend that is seen to make higher highs higher highs than those created in Asia. So in the bearish normal protraction profile, given that we have significantly consolidated central bank leaders range and Asian range, we can project standard deviations of these ranges, and given supporting confluences and the relevant context, use them to infer likely protraction targets. So the protraction stage in this example reflects turtle soup conditions as price moves above an old high. Ideally, we would anticipate some measure of SMT divergence supporting the turtle soup sell. In this example, we are able to use an inverted fair value gap to further support the narrative that market structure has shifted, as we begin to note candles which close inside its value area. Also in this example, an opportunity to enter into a continuation trade between 3 and 4 AM forms. Right, moving on then to the next example. So in the second example of the bearish standard protraction, and the last profile we will cover is of course the bearish delayed protraction. Again, we assume a high time frame, daily, weekly, or monthly drawn liquidity below market. In the anticipatory conditions, if the midnight trend is bearish, we want to see lower lows formed before 1:30 a.m. Between 2 and 3 a.m. is when we anticipate the protraction stage in this profile. We will prioritize internal range liquidity, protraction targets. And what does this mean for us? Well, we want to sell short at premium arrays. We want to note any imbalances above swing highs, as they will represent both liquidity and imbalances. Liquidity, so the redistribution model can unfold, and fair value gaps, so that the algorithm can balance inefficiencies, both of which represent the highest degree probability for reversal. I want you to also note any fair value gaps that are formed as price moves into opposing liquidity, because it will likely represent an opportunity to sell at should the market reprice and fail to close above them. As for the entry conditions, they're much the same as in the previous profiles we discussed, using inverted fair value gaps as a reference and a way to measure a shift in market structure, was a way to measure a shift in the sentiment. Right, so should we witness some measure of redistribution in which we see higher lows in the euro as compared to lower lows, say, over in the dollar, from there we can monitor whether price is seen to move through a swing low, in which case we can infer that a market structure has occurred. If we are able then to use an inverted fair value gap as a means to measure a shift in sentiment, this is even better and builds our case for a potential reversal. Again, between 3 and 4 a.m. is when we're going to prioritize continuation trades, and if they form below the midnight open, we note these as being particularly important. So we'll move on to the examples. So the key features I'd like to note here is the fact that we have a midnight decline, right? So a bearish trend. This sets up stage for a delayed protraction profile. Then at between 2 and 3 a.m. we have the protraction. Now you'll see price trades through the swing higher into this imbalance, but also into the open of this bearish order block. This fair value gap is created in opposing liquidity. So opposing liquidity is situated above, in this case, above swing highs, as they exist in a premium market between a dealing range. So you'll see here we have a retracement of that, but then price is seen to rally one more time, and you'll see here candles close inside of that inverted fair value gap, essentially creating a balanced price range. After that, price is seen to expand quickly and reprice to lower levels on the day. Moving then on to our next example. In this example, we have a rather consolidated Asian trend that extends into midnight. In a situation like this, the protraction stage can tend to engage external range liquidity. When this happens, or when we see a sort of a formation like this, we should anticipate a return to above all highs. We can use inverted fair value gaps as targets, again, to measure market conditions. So you'll see here on a higher time frame chart, prices, these candles bodies are seen to close in the value area of the inverted fair value gap. Between after 3 a.m. the price is seen to expand. We have a fair value gap which is created here. We have a bearish order block and a swing high. This entry here would be consistent with the 2022 model as ICT teaches it. So price engages liquidity above a swing high, and you can sell short at a variety of premium arrays, in this case the bearish order block or the fair value gap. And with that example done, we finish this presentation. So what I tried to do here was to blend a number of key ICT lectures, information about institutional market structure, about distribution and accumulation models. We incorporated time theory and showed it is possible to anticipate when reversals are more likely to occur. We looked at ways to use the violation of PD arrays as a means to measure shifts in sentiment. We focused in on the use of inverted fair value gaps to support our analysis and showed we can use them as a mechanism to enter trades. This was an introduction, an example of how to incorporate and blend together the many components taught by ICT and form a trading plan. If you did enjoy, be sure to subscribe and give this video a like. Join my Telegram, and remember, every process has a genesis and ends with a revelation. Until next time, my friends, God be with you.